is often the case at this stage of the month, the UK unemployment, wage growth and inflation figures will take centre stage this week from a macroeconomic point of view. Remember that for May, unemployment was just 3.8%, another 45-year low. Employment was 76%, just a smidgen down from the all-time high the month before. And wage growth reached 3.4% with bonuses and 3.6% without them. The latter figure was the best in 9 years, and better still, wage growth beat last month's inflation figure of 2%, as based on the Consumer Price Index. Now that may bring some relief to consumers and also possibly retail, travel and leisure stocks. There's one other reason though why you might want to keep an eye on the inflation figures for July. The increase in the Retail Price Index, or RPI, will determine how much the cost of your train season ticket, and a few other items will go up as of January. As we can see, the trend in RPI here, and the last reading for June was 2.9%. So, fingers crossed, my fellow commuters. Now, after a rush, the number of corporate results due for release is slowing down, although not quite to a crawl. The coming week could see some informative updates from large and mid-cap names alike. Companies which may be worthy of note, either in their own right or because of the read-through they provide on the UK or global economy, could include shipbroker Clarkson on Monday the 12th of August, travel agent TUI, retailer Card Factory and the AA on the 13th, life insurer Prudential, Balfour Beatty and car retailer Lookers on the 14th, online gambling services provider and high street bookie GVC, and concrete paving player Marshalls on Thursday the 15th. However, for me, the stock most likely to cause a big fuss in the week ahead is car insurance giant Admiral. The FTSE 100 firm is due to release its first half results on Wednesday the 14th of August. Best known for its Admiral, Elephant and Diamond brands, as well as the price comparison site Confused.com, Admiral's headquartered in Wales and is a member of the FTSE 100, but it's a global company with operations in Spain, Italy, France, America, Mexico and Turkey to name but a few. As we can see here, the shares are up by around 10% over the past year, and over the same period the FTSE 100 is very slightly down in capital terms, so the shares haven't done too badly. However, Admiral shares have been pretty volatile, and three reasons may lie behind the ups and downs that we've seen. First, Admiral's results in 2018 showed a slowdown in the core UK motor business in the second half as the company changed tack and opted for margin over volume in response to increasing claims costs. This was partly to protect it from an increase in the cost of car repairs over the last couple of years, thanks to rising parts and labour expenses. Second, the insurance industry has been hit by government intervention in the so-called Ogden rate. This is used to calculate compensation payments to victims of car accidents based on the return any money paid out can earn when it's invested. The lower the Ogden rate, the bigger the lump sum the insurers must pay out. And in July, the Lord Chancellor set the rate at minus 0.25%. Now that was an improvement on the prior result of minus 0.75%, but it undershot industry hopes for a figure of between plus 0.1 and plus 1%. This could, in theory, oblige insurers to jack up premiums if they're to meet analysts' earnings and dividend forecasts. And Admiral does look a bit exposed here, as it had assumed an Ogden rate of 0 for its reserves in 2018. Now third, the regulator is getting involved in another way. In autumn, the Financial Conduct Authority launched a probe into what it called, and I quote, the excessive difference between premiums charged to those new customers and those renewing, with the former, in theory, getting better prices at the expense of the latter, especially in home insurance. Now, if the regulator gets really tough, this could lead to a fine or compensation payments, and there's a risk that this line of thought spills over into motor insurance as well, which is much more important for Admiral than home insurance when it comes to premium income. So, analysts will be looking for comments on all three of these themes alongside the first half results, when they will also look to the headline pre-tax profit and dividend numbers to judge what impact, if any, those issues are having. In terms of pre-tax profit, therefore, Admiral will actually set a new company high in 2018 at £476 million. For this year, the current consensus is a slight dip to £450 million. So that rate of change may be your benchmark for the first half, when Admiral made £211 in the first 6 months of last year. Then we come to the dividend. As I sit here, Admiral's the 30th highest yielding stock in the FTSE 100, with a forecast yield for this year of around 5.5% according to consensus forecasts. Now last year, Admiral paid an interim of 60p, a final dividend of 49.6 and a special of 16.4 for a grand total of 126 pence a share. Now at the start of the year, analysts had penciled in 142p, but that number has dribbled down to around 121 pence, a slight drop year on year, which would be understandable given Ogden and everything else. In terms of the finer points, analysts will be looking at the trend in total group customer numbers, which rose 14% last year to 6.5 million, UK insurance customers, the core business, which rose 13% to 5.2 million last year, and the solvency ratio, reflecting 2016 regulatory requirements, and that ended 2018 at 194%. Now this number measures how much capital an insurer has relative to the risk it's taken on its books. A ratio of 100% under Solvency II means an insurer should be able to meet all of its obligations even in the event of an extreme shock. So Admiral looks very well capitalised on this yardstick. Thank you for watching, and I look forward to seeing you next time.